The grains of sand are falling, my friend, and with the passage of time this year, you're gonna see interest rates rise, and worse, house prices are still going up. Can you imagine a real estate market where prices go up, and then what happens if interest rates go up? It's gonna change the entire housing market. How? Check it out.
One shot, now the future is yours. Go! I'm turning dreams into reality. Yeah. It's one shot, now the future is yours. Go!
Dude, I remember back 2008 when the crash was just hitting in mid-October. There was this house that I was about to close on, and I had already negotiated, it was like an 8% interest rate. Like literally that was normal back then. It wasn't 4%, it wasn't 3%. It was an investment property with an 8% interest rate. And literally the bank was about to go under. And so the day before closing, they said, oh, just kidding, we changed the interest rate. It's now 16%. And I'm like, I'm not closing on this bank loan at a 16% interest rate on this property. And of course they knew that. They were basically saving face. That interest rate killed the cash flow, killed the deal. Turns out it also killed the bank. Listen, interest rates are really important to investors because they determine what payments are. And so just because interest rates go up, it doesn't mean that cash flow goes up. So imagine that you're an investor buying a property and it's going to have, $400 a month of cash flow. If all of a sudden rates go up a full point, that $400 a month could turn into $250 a month of cash flow. And all of a sudden your cash flow almost gets cut in half. And it means, hey, if I buy this property and something goes wrong with it or there's an unexpected expense, all that cash flow, what if that's not enough to literally cover those expenses? At the end of the day, interest rates are super important in whether or not your investment strategy will work long-term or not. I get asked all the time about interest rates. Kris, does an interest rate make or break a deal? Is there a point at which rates go up so high that you just stop buying real estate? And in theory, that could kind of happen, but the reality is that I'm always looking for a deal that suits the interest rate, no matter what the banks are charging, because leverage is your friend.
You got a friend in me.
So check it out. Today, we're gonna talk about mortgage rates in 2022 and how they're gonna be changing, because guess what? They are currently changing. And when I say that we have a problem with time and that it's running out, it's because I think quarter over quarter this year, we're going to see something happen to interest rates, and it's going to change your game plan and strategy. I love borrowing money from the bank. Banks make me a lot of money. And you know what? Banks also make a lot of money. What's in it for me? What's in it for them? Well, think about it. Most banks will put up 80% of the money on a deal. If it's a primary residence, a house you're going to buy, they'll put up 97% of the money. Why are they willing to do that? Well, I know why I'm willing to do that. It's because if I buy real estate with an advantage and cash flow and tax benefits that goes up in value, I'm going to make a grundle of money. But you see, banks, they're not really in the game of real estate. They're in the business of lending money. For example, did you know, this is $100,000. When a bank lends $100,000, for each $100,000 that they put out, they're expecting $250,000 to come back to the bank over the life of the loan. That's right. When you actually make your payment every month, not all that money goes to pay the house down. For the first several years, the amortization schedule is rigged so that the majority of every payment you make is actually going to the bank in the form of pure interest. That's how they make money. And you know what? Fair is fair. They can make money lending money, but I get to make way more money as a successful real estate investor, which is why today's video is so important for you to pay attention to, because guess what? The game is about to change.
I want to play a game.
All right, every bank out there has a slightly different interest rate. How do banks even calculate these interest rates? Well, let's take a look at it. Typically, a bank or mortgage lender will finance 80% of the price of the home, and you agree to pay it back over time with interest. And for most people, that's over a 30-year term. They're actually talking about 40-year mortgages, and of course, you have 15-year and even 10-year mortgages. Now listen, you can go online. They've got these online mortgage calculators, and they take multiple factors into account to determine what your interest rate likely is going to be. Changing the economic conditions, central bank policy decisions, investor sentiments, and other factors are definitely going to influence the movement of overall mortgage rates. In other words, banks aren't in charge of it alone. It's also the government that has their hand in determining whether those rates go up or down. Governments, banks, they're going to do what they're going to do, and it affects all of us. But there are things that you can do that definitely affect what the rate looks like for you. Generally, a good mortgage rate is one that's the lowest you can qualify for based on your individual factors, such as credit history, income, other debts, down payment amount, and other things as well that we're going to talk about today. Before the pandemic, the average mortgage rate was around 4 or 5%. So it was certainly higher than we have right now. Which kind of begs, why did the government decide to lower interest rates? To stimulate the economy. We have problems. That pandemic said, stop business. And so like, well, what sectors can we move? The housing sector is one of the biggest in this country. So if they lower rates, guess what it does? It says, hopefully that will tell the people, go buy real estate because interest rates are so low. They've done that now for the last couple of years. And guess what? We've seen buying happen at all-time highs. There's not enough real estate out there. People are buying like crazy. It's driving prices through the roof. So do you think that the Fed is going to keep rates low? Wait, Kris, rates are about to go up? Oh yeah, yes. In fact, I'm about to show you by how much. But first, how low did they get and what should you be doing right now? Check this out. So you've got your typical 30-year fixed mortgage rate. We've literally seen those down as far as 3.3%. Then there are some people who are like, you know what? Give me a bigger payment. I want to lock in an even lower rate. And so they'll go to a 20-year fixed mortgage. They'll see that drop to 3.1% on a 15-year fixed mortgage, which means I'm not going to pay off the home over 30 years. I'm going to pay it off in half the time, 15 years. Your payment's going to be about 40, 50% higher, but you'll get that rate down to 2.7%. And even on a 10-year fixed mortgage, we've seen it in that 2.5% range. So you look at it, I call this free money. Like rates historically really can't get cheaper than that because part of what's left over in that rate is making sure banks can make money. Like there's an amount that they need that says lending money actually makes sense for us. So you've had it, historic lows that we haven't seen for decades, and yet they are going to start going up. It is going to change the game. But it's not too late for you to do something about it. And I'm talking about a really important good thing that you really need to be doing right now. So check out this graph. We've got August 2021, and we see the movement of rates all the way now through January 2022. By the way, do you see what's happening right here? That cute little, hey, check it out.
Hey.
That's rates going up. And so look at the trend. It's pretty obvious to see what direction things are going in. Right now, when we were experiencing the worst of the pandemic and businesses were shut, they weren't allowed, the government was doing everything they could to make sure you can't get foreclosed on your house. We're going to try to have the SBA and government kick in to help you save your business. But you know what? That went on for a while. And then at some point they said, we cut in the cord. It's time for you to stand on your own 2 feet. And part of that means rates are coming back up. And I need you to understand something. The government needs the rates to come back up because they're making some fiscal decisions right now that are really going to put us in a bad spot with hyperinflation in the next couple of years. And what are they going to do to counteract it? They have to be able to potentially lower the rates again. So think of interest rates as kind of like a lever. If they put it up too high, no one transacts in the economy. If they put it down really low, everyone wants to move. They have to slowly inch it back up so they can get control over the lever again, so that if things get really bad and it hits the fan, yeah, boy, they can try to speed up the economy by dropping rates again. What goes up must come down. That's what a lot of people are thinking right now when they're saying, okay, if mortgage rates go up, what's going to happen? Isn't that going to slow the economy down? And shouldn't that keep property prices from going up? Shouldn't it, in fact, even potentially lower them? Well, interest rates are definitely going to be a driving force because part of what allows a home price to keep soaring is when you have not enough supply and you have this crazy amount of demand. That's not going away. But if all of a sudden interest rates go up, there's going to be some people who are going to say, I thought I wanted a house. Maybe I don't want a house that much because guess what? The rates just went up a full percent. That means that my payment just went up maybe $100 or $200 or $300, and they say, I just got priced out of the market. So some people might be thinking, hey, if rates keep rising, maybe it will slow down or even lower the price on real estate. The market force of supply and demand is too big for something like an interest rate to really have a really meaningful impact. Right now, we are missing millions of homes in this country, and there's such an imbalance. We haven't historically ever seen an imbalance this bad. We have such a demand for homes that literally aren't present, that you're going to see for the next 5 to 10 years, those prices have to keep emerging. They have to keep increasing. They have to keep going up. And you know what? Maybe increasing the rates will slow down some of that, but it's not going to drop it. You're just going to maybe affect some of the acceleration so that it's not as steep in the curve. So what should you do with this information? Like if rates are going to go up, should you even care? Well, first of all, if you're watching my content, it's probably because you want to be a more successful entrepreneur, you want to get into real estate investing, and I'm telling you right now that you have a chance to lock in these really, really low interest rates on property. For me, I'm buying as much property as I can possibly get my hands on, which means I'm going to the bank and I'm borrowing as much of this at these low rates. Even if rates go up another %, that's still super cheap for me. I still can maintain really positive cash flow. I'm going to keep on going. If rates were to go up, 6, 7, 8, 9%, obviously that's a different story. It's going to get a little bit crazy. I just want to share that there's something that you should be doing right now. You should be buying as much real estate, and understand that it's a function of time, right? Like if I take advantage of time right now, I can lock in low interest rates right now, but there is another thing that you can do that can help bring your rate down. There's 5 factors that really determine what interest rate the bank is going to give you. Number 1, your credit score. So if your credit score isn't as high as it could be, guess what? If you go into a credit repair program or a credit maintenance program, or you get a couple things knocked off your credit, by improving your credit score, banks will say, we should give you a more advantaged interest rate. Like rates just went up, but guess what? We're gonna bring them back down for you because you've improved your credit score. Or number 2, you can decrease your debt to income ratio. Debt to income ratio? Yeah, like this is the amount of money that I make in a year, and this represents how much money goes out the door in debts. If I can eliminate some of these debts, I look less risky to the bank because they're going to say, oh, you've got more leftover money after you service your debt. So if you can decrease your debt, we're willing to lower your interest rate. You can also lower your interest rate by literally increasing your down payment. So when you buy an investment property, you got to put 20% down. This has been really weird the last 2 years. If you put down 25%, 5% more, banks will do a pretty significant rate drop. And so on a lot of my properties, I've taken advantage of that. That's kind of a new thing that's not normally out there. And then of course you can shorten your repayment period, which means, well, I could do a 15-year instead of a 30-year. Your payment's going to get jacked, but you'd get the house paid down. And if they see that you want to be more aggressive in paying it off, guess what they say? We'll lower your interest rate. By the way, as an investor, I'm not interested in paying off the house sooner. I'm personally interested in controlling real estate, and I want to control as much as I possibly can as long as my ratios and numbers are good. And the last thing you can do is work with a highly rated broker. And what I mean by that is if I'm a broker who is writing loans for the people through this one bank, if I write 10 loans a month, I'm going to be treated one way, but if I write 30 loans a month, I'm going to be treated a different way. So as the broker, the person you're doing your loan with, the person who does a lot of volume can reach a status internally inside the bank that gets them recognized with a higher status. It means they're really good at doing a lot of business, and they reward the broker by passing really good rates on to their clients as well. So you can also score a better rate just by working with someone that's doing a lot more business. At the end of the day, my friend, you should be asking yourself, how can I leverage my credit to get more money from the banks? And how do I get the lowest interest rates? Well, guess what? I work with those brokers that get me literally the prime rates, the best rates possible. And there's a document that I've published that I want to give you for free. There's a link below, and I'm going to send this out to you. And what it's going to do is it's going to show you where I'm buying real estate, and it's showing you how my strategy works that allows me to get the lowest rates possible. Low rates equal higher cash flow. It means greater profits. It usually means a smarter investment play. This document will take you through the last several thousand properties that I've purchased, the exact strategy that I'm using, and how you can copycat me. But it also entitles you to talk to a member of my team that can actually connect with you and give you a game plan. What would Kris do if he was in your financial situation? If that's valuable to you, click the link below, pick up a copy of this. It'll be highly informative. More importantly, it'll show you how to actually leverage your credit for making money instead of hurting you like a lot of dip phases do by going into debt, credit card debt, and buying things that they shouldn't. Buy assets right now while rates are low. Sometimes I feel like a lone voice in the wilderness because guess what? There's a lot of people that watch this video and say, why would you want to go to a bank and borrow money to buy real estate? You should just rent. In fact, it seems like everyone is like preoccupied with renting, and there's a reason why. And there's a fallacy in that, and there's also an opportunity. And if you want to know what it is, watch this video and let me show you how it works. You are running out. If you're gonna get in on one of the biggest real estate booms, I'm to that, okay?
You're Kenneth Copeland, started speaking with time. Couldn't think of what it is.